Traders, welcome back to another video. And in today's video, we're going to break down what happened with this morning's CPI report and what did that mean for the markets. And one of the things that we're going to do in order to break this down is we're going to leverage a premium feature that is a part of Macro Edge. For those of you who've been watching my videos, you've probably already seen me talk about Macro Edge, a project that's currently in the works that I'm super excited about, that I do believe is going to bridge the gap between retail understanding institutional. What happened with today's CPI report and how did it impact the markets? According to Macro AI, CPI came in softer than expected. June US CPI reported cooler than expected, with energy weakness driving the downside surprise that reduced near-term inflation anxiety. The market reaction was stocks rose, Treasury yields eased, and the US dollar weakened as traders pared back Fed tightening risk. The FX impact to this was softer CPI was bearish for the US dollar, Euro USD gained, and risk-sensitive FX got relief. US dollar downside remains valid while yields stayed pressured. And as far as commodities, some of you guys already know we were trading gold earlier today. Absolutely nailed gold, back-to-back trades on gold. But essentially what we got was gold rallied on lower real yields pressure. Oil's move was less CPI driven and more tied to ongoing US, Iran, Hormuz geopolitical risks, which for those who don't know, over the weekend, Donald Trump decided, hey, let's go ahead and flare up this war, bring this thing back to phase one. And that's pretty much where we're at right now. The most important thing to understand here is the context of what today's CPI numbers really mean. And this is where a lot of traders are getting absolutely chopped up in the markets, thinking that because CPI came in cooler than expected, that all of a sudden that dollar pressure, that dollar downside is going to persist. But what they fail to realize is one very, very, very important piece of information. And it's actually in the report itself. June CPI report. Emphasis on June. Why is it so important to go back and take a look at June's inflation report? Because what happened in the month of June with oil prices? Let's first think about, right, if we're going to take a step back, let's first think about what initiated the inflationary fears, the rise in oil prices to begin with. It was the war in the Middle East. And what happened in the month of June? Oil prices came down, dragging yields lower, calming the markets down, inflationary fears easing. If you go on the charts and you look at crude oil, you'll notice that for the month of June, crude oil actually pulled back. The oil prices did ease for the month of June, and that's a reflection of today's CPI report. So do not get caught up in the headline. Do not get caught up in the figures, because it is completely justified as to why today's reports came in cooler than expected. But what now I need you guys to think about, and this is where you as a trader need to be forward thinking, the same way that the markets are always forward thinking and pricing in what's likely to happen next. I need you guys to start becoming forward thinkers and thinking about, okay, this is what happened in the month of June versus where are we today? What have we recently seen regarding geopolitical risks, regarding the war between US and Iran and conflict starting to rise all over again? We've seen that we've gone right back to the very beginning of this phase where the US and Iran are attacking each other yet again. In fact, President Trump announced to Congress that the US is officially back at war with Iran. So again, we're back to phase one, which essentially means what? More demand for US assets, more demand for dollar index, more pressure for commodities like gold, like silver, so on and so forth. And the playbook repeats itself. So I need you guys to pay attention to this, because moving forward, it's going to be all about inflation. How does that impact interest rates? And you also need to keep a close eye on oil prices. How are oil prices influencing all these other markets, from bond yields, dollar, commodities, so on and so forth? And as long as you can keep up with that, you'll be able to know exactly how to trade everything else in between. But not financial advice, of course. I'm just giving you guys my understanding from my perspective, utilizing these amazing tools at my disposal and hoping to help you guys navigate your way through this constant back and forth. So appreciate you guys for tuning in. I'll see you on the next one.